Let's kick off this explainer with a number that should immediately grab your attention: a 28.26% margin of safety. When you're looking at massive, established companies, you rarely see a fundamental discount that deep. But that is exactly what the data is telling us today. What's really fascinating here is the sheer size of the gap between what the market is paying today and what the underlying cash flows say Constellation Brands is actually worth. On one side, we've got a current trading price of $152.29. On the other, an absolute fair value price of $212.27. How does a gap like that even exist? Welcome to this fundamental valuation explainer on Constellation Brands, ticker symbol STZ. I'm putting on my sell-side analyst hat today. We're going to look strictly at the hard numbers, pull apart the financial metrics, and figure out if this stock is a hidden gem or a value trap based solely on the data in front of us. Here is our roadmap for the analysis. We'll establish our baseline, assess the financial health, run relative and absolute valuations, address our analytical constraints, and finally deliver the verdict. Section 1, the baseline, unpacking recent price action. The market has clearly been punishing this stock recently. Sure, we've got a positive year-to-date bounce of nearly 12%, but looking back over the trailing 12 months, we're down over 16%. And the stock is sitting more than 22% below its recent 52-week high of roughly $197. The stock is bruised, which actually sets the stage perfectly for a valuation check. Section 2, financial health and growth, assessing the foundation. Okay, the recent volatility here is absolutely wild. We've got a trailing 12-month net income spike showing a growth rate of over 2,100%. Seriously, that is not a typo. But you compare that to a slightly negative 5-year trend, down about 3.3%, this tells us we're looking at a massive recent turnaround, a one-time accounting windfall, or a crazy recovery from a distressed bottom. Moving to the balance sheet, it's all about efficiency and survival. The current ratio is a totally manageable 1.08, meaning short-term obligations are covered. Return on invested capital is a solid 10.57%, proving management knows how to generate good returns on the cash they deploy. Debt to equity sits at 1.31. It's a little leveraged, sure, but well within normal operating parameters for a mature consumer defensive company. Section 3, relative valuation, looking at market multiples. These multiples paint a really interesting picture. A price-to-earnings ratio of under 16 and an EV to EBITDA around 10.5 suggest a relatively modest, almost value territory valuation for a company that just posted such a massive net income spike. Price to sales is 2.87. Honestly, none of this screams overvalued tech darling. It all looks incredibly grounded. Now, full disclosure as your analyst, the source documents don't explicitly list peer companies, so strict methodology means I have to state an external assumption here. If we bring in obvious publicly traded comparables like Anheuser-Busch or Molson Coors to contextualize these numbers, Constellation's multiples heavily imply a very conservative valuation against its industry peers. Section 4, absolute valuation, diving into the discounted cash flow and DDM. To build our discounted cash flow model, we follow the classic strict steps to bridge reported financials to intrinsic value. We extract the robust trailing free cash flow, which the data confirms is a massive $1.794 billion. Then we estimate a risk-adjusted discount rate, calculate the terminal value for those far-out cash flows, and discount the whole thing back to today. Following that math through our provided data, the model spits out an absolute fair value price of exactly $212.27. This is our bedrock number. It ignores market popularity and focuses purely on the present value of the actual cash this business throws off. And because they pay a solid dividend, applying the dividend discount model makes perfect sense. The data shows a current yield of 2.71%, backed by 11 straight years of increases. Even better, that payout ratio is a super sustainable 42.43%, alongside a 5-year dividend growth rate over 6%. This just further validates that their underlying cash generation is incredibly stable. Section 5, addressing missing models and our analytical constraints. As a rigorous analyst, it's vital to disclose what we cannot model based strictly on the provided documents. We have to skip a sum of the parts analysis because we lack segment-specific reporting. Adjusted present value is out since we don't have forecasts for changing debt levels. We're missing forward net income estimates, so no residual income model either. And an expanded liquidation value? Impossible without a highly granular asset-by-asset balance sheet breakdown. By explicitly declaring these limitations, we keep our fundamental valuation protected from speculative guesswork. I could invent segment revenues or guess future debt schedules, but that destroys the rigor. Instead, we fall back on the most unmanipulable metric we have, the primary free cash flows we just proved out. Section 6. The final analyst verdict, synthesizing the pitch. We are left with a fascinating, glaring disconnect. Look at the recent price action. The trailing 12-month price KGR is negative 17.54%. The market is treating STZ literally like a falling knife. Yet, our absolute free cash flow models are screaming premium, handing us that robust 28.26% margin of safety up to our fair value of $212. So, I'm going to leave you with this pivotal question. Based strictly on the hard numbers and the rigorous valuation models we've run today, is Constellation Brands a deeply undervalued cash machine just waiting for the market to wake up? Or is the broader market actively pricing in some forward-looking risk that strict historical financial fundamentals simply miss? Thanks for joining me on this explainer. Keep asking the hard questions and always look at the data.